Hello, and welcome to the State Street Digital Podcast, the third in a series where I'll be discussing subjects covered in our quarterly Digital Digest publication, with the authors of articles from the most recent digest. I'm James Redgrave, Vice President of Thought Leadership and Editorial for State Street Digital, and I'm joined today by Michael Metcalfe, Global Head of Macro Strategy at State Street Global Markets, and Denis Dollaku, Head of State Street Bank International in Italy. In October's Digital Digest, Michael and Denis contributed pieces respectively on the recent bout of cryptocurrency downselling, nicknamed the Crypto Winter, and an interview with the Chief Investment Officer of Fideuram Intesa San Paolo Private Banking on cryptocurrencies as a potential institutional asset class. Michael and Denis, welcome.
Hey, James.
Thank you.
Michael, the data in your article suggests that investors are taking an increasingly buy and hold approach to Bitcoin. And Denis, your conversation with Ricardo Negro from Fideuram revealed increasing institutional investment in the asset class. Are these two trends related?
Why don't I take that first, James, and then Denis can come in and correct me. I'm not sure, to be honest. So the one thing that we can learn with some of the data that we get from Glassnode are the kind of wallets or groups of wallets called entities that are currently holding Bitcoin and how those have changed this year. Which, as you say, it's a full-on winter, perhaps the worst winter that crypto and Bitcoin has ever seen in terms of the market cap drawdown for sure. We've had volatility before, but we've not seen a destruction of market cap like this before. But what seems to have happened that the wallets and groups of wallets and entities that are left holding Bitcoin today are typically entities that accumulate over time and are therefore long-term holders. And therefore, you can say that is, of course, a characteristic of what we know in traditional markets as long-term buy and hold investors. So it may well be that the holders of Bitcoin share those entities, but obviously, look, everything on chain is anonymized. We don't know for sure that they're actually the actual institutional investors that, of course, that Denis is talking to. So Denis, I've just bumped that across to you. So you can tell me what the institutional investors are actually thinking and doing about it.
It's interesting, actually, because when you think about it, cryptocurrencies in general and Bitcoin in particular have gone through a number of market cycles of buying, selling in the last 5 years. When you think of where we were 2015, and actually the capitalization of cryptocurrency was at approximately 5 billion, it went up to 2 trillion 2020. It's down. Of course, it has tumbled considering the current raises in interest rates. And so the capitalization has gone down to approximately 1 trillion, which is what James referred to as the crypto winter. However, one has to remember that despite such volatility, crypto assets have a unique and innovative characteristics, both in terms of risks and yield drivers. And so we can say that the crypto sector represents a new asset class with an important role for diversification. That's why institutional investors are warming up to crypto assets as they look for additional income drivers, considered such asset as a potential inflation hedge. And as said before, they look for diversification. So from an institutional investor point of view, this seems like a natural process of consolidation of the sector within the portfolio strategies.
Yeah, and I might just jump back in here, actually. I think that we have learned a lot this year in terms of what Bitcoin can deliver and maybe what might be more of a struggle for it in terms of the kind of the wish list for institutional investors as they kind of consider taking it up. And I do think, and you mentioned, Denis, I'm sure this came up in your conversation with Fideuram, is that this idea is that could Bitcoin be an inflation hedge? And I think unfortunately this year what we've learned is that even though Bitcoin has this scarcity kind of built into it, obviously it hasn't proved a very effective inflation hedge this year. Now, of course, Bitcoin is a very young asset, and we're still learning its attributes. But I do worry that so far the kind of the empiric reality this year has been that it hasn't been a particularly good inflation hedge, and nor actually, unfortunately, has it diversified away from equity risk. I think if anything, what seems to have occurred is that we've kind of learned actually this year that crypto generally is it's very correlated to tech plays and tech equities in particular. Which if you think about the ultimate use cases of many of these things, I think that kind of makes sense. And I think it will take a lot longer for Bitcoin and other crypto digital assets to build their cases that they offer things other than that, like diversification and inflation hedges. That's at least the kind of the empiricism of what we've seen this year, I would say.
Thanks, Michael. And I did want to come on to the sort of use cases of Bitcoin potentially in institutional portfolios or what investors might use them for. So thanks for touching on that. If the investor base for cryptocurrencies, Bitcoin, etc., does expand into the institutional universe and there's significant increases in demand, what implications would that have for these asset classes in terms of, Michael, you mentioned scarcity, for example. What would the implications be for liquidity and availability of these and the depth of these asset classes in a high institutional demand environment?
It's a really interesting question because the one thing that we can say, I think with a fairly high degree of certainty, is that even after the big, collapse that we've seen in market cap this year, certainly the large crypto assets are still very large indeed, and the trading volumes remain very high. However, unfortunately, and this is, I suppose it's both a good thing and a bad thing that if more than 75% of Bitcoin, say, is held by wallets or entities that typically accumulate and don't sell very often, that means the kind of the free float. In other words, the amount that's available for trading, buying and selling every day is actually a relatively small proportion of that. And I think I do worry going forward that as more longer term like players come into the market, and because the supply is fixed, of course, that's in theory Bitcoin's main appeal, that liquidity, so while it might be good for the price trend that more of these long-term investors come in, I think there will be some question marks about liquidity. Although look, I think the one thing I would just stress on liquidity is this liquidity question is certainly by no means a problem just for crypto assets. I think it's a significant challenge for a huge swathe of traditional asset markets as well. But I do think there is this question as they adopt as to just how much of it will be tradable, what that means for liquidity. And then, of course, the thing that follows on very quickly from that is that if it remains somewhat illiquid, then it also means it's very volatile. And I think that's the other thing, of course, that we've learned this year, and that we've learned, I think, over a number of years. This is not unique to this year, which is that as Bitcoin has become massive in terms of market cap, it hasn't become any less volatile yet.
Michael, let me pick up on that, right? Because exactly for that reason, I think it's cryptocurrency, Bitcoin especially, is showing quite resiliency, right? Despite of what's going on, because let's think about it. I mentioned before, it went up the market cap to approximately 2 trillion. Now it's down to 1 trillion, which is still large, as you said, Michael. But that considering, despite the fact that, let's remember, in September 2021, China banned crypto mining. And actually, earlier this year, Elon Musk highlighted the environmental cost of mining cryptocurrencies. And that actually caused Bitcoin to plunge below 30. Then we've had, inflation, the raise of interest rates, and the value has continued to drop to 20K. But still, as I said, it's a very large market cap asset class. And if you were to look at, I don't know, you guys probably heard about it, this crypto fear and greed index, Bitcoin is now in the extreme fear zone, right? The crypto fear and greed index, it's provided by alternative.me, ME, which aims to give a rational overview of the current sentiment over Bitcoin and crypto market, trying to get the emotion out of it. And extreme fear can be a sign that investors are too worried, but there where some see risk, other investors see a buying opportunity. That many institutional investors now have elected, or a growing number of institutional investors are electing to have cryptocurrencies as part of their buy and hold strategy, right? I talked about earlier about the diversification. And again, not to sound like a broken record, but I think it would be a mistake to think of this as the end of the crypto assets, but we can consider this as a natural process of consolidation of the sector.
I would agree with a lot of that, Dennis. And look, I mean, I think just to kind of scale the size of the stress test that crypto assets have had this year, by our reckoning, if you kind of pull it back into 2022 dollars, the destruction in market cap here is is of a similar order to Lehman Brothers and the Great Financial Crisis. And it's also, for those of you that are a bit older like me, it's about 4 times the size of LTCM, which was the hedge fund that went under around the Russian crisis. And so those were massive systemic risks for traditional asset markets, and that's exactly what crypto has gone through this year. It seems to be of a similar size, and as you say, here we are. This certainly isn't the beginning of the end; it's the end of the beginning. I think, and we're kind of narrowing in now on what these assets are and what they're not, but they are still here. They're still large, and as I said, that has been a ginormous stress test that a very young asset has managed to get through. And of course, look, I mean, it hasn't been that there've been some pretty significant difficulties along the way with things like terror and question marks about stable coins, and obviously some hedge funds have failed as well. And so it's not saying that it hasn't been without its significant difficulties, but we are still here, as you say, Denis, and it will be stronger because of it.
I want to hear your view, Michael, on something, right? Because when I talk to people around the market, you see that people are afraid of equities, people are afraid of fixed income, people are afraid of funds, and so on and so forth. In terms of performance, right? That's what I mean by being afraid. So there are difficulties in performance. So I think this pushes again the case for crypto assets and Bitcoin in particular to be part of the strategy, to diversify, to try to look a bit for alpha. And when I look at surveys out there, I read that out there by 2026, 7% of the assets of institutional investors will be in crypto assets, right? Cryptocurrencies. And actually, if we look at the hedge funds more specifically, right? Hedge funds, even currently, they have, was reading somewhere, 38% of traditional hedge funds are currently investing in digital assets, which is up from 21% just 1 year ago, right? So despite everything, exactly for the reason of having an additional asset class that can generate alpha, this is gradually becoming part and parcel of the buy and hold strategy. But I don't know, Michael, what do you think about this difficulty in finding alpha in traditional assets as being the case of pushing more for crypto assets?
Yeah, look, I think it's a really good comment and question, Denis, because look, as we know, 2022 has been, if you're a long only investor, there's been no choice but dollar cash, not even gold. It's been extremely difficult to generate returns. Look, fortunately, these environments are quite unusual, but in this kind of environment, obviously investors will have to try and rethink their investment models somewhat, and they will be obviously open to looking at alternative investments. Obviously, I think it's quite possible that crypto is part of that. I don't think it surprises me too much that hedge funds have been, obviously faster to adopt. As we've talked throughout this piece, these are large markets that are moving around a lot, which is perfect for a hedge fund who, is able to trade long and short, of course. I'd be slightly cautious of extrapolating hedge fund involvement to what that means for a kind of traditional real money long only investor. I think generally they've got very different investment mandates. And I do think that the challenge for those longer term institutional investors is the question of volatility, because and look, as I mentioned, some traditional assets, have proved that they're far more volatile than we thought. But there's no surprise in Bitcoin, that Bitcoin has a volatility somewhere between 50 and 70%, depending on the period. And that is a highly volatile asset to want to put into your portfolio. But of course, that doesn't mean, and look, obviously we focus a little bit here on Bitcoin, but there are many other crypto assets or applications of digital technology that institutional investors will also be looking at. But I think for them right now, for them to put Bitcoin in their portfolio, they have to have a utility function that makes them want to take quite large and risky bets, which at the moment is what Bitcoin still looks to be like.
Yeah. And by the way, I don't want to sound overly optimistic, right? Because there are several things to sort out. There are regulatory topics to sort out. There are reputational risks related to the use and the production of Bitcoin. We talked about the resources for mining, so the impact on the environment. I was reading somewhere that it takes more energy to produce Bitcoin than to actually have for entire countries in Europe. So there are several topics to sort out. It's just that what I perceive is there is this trend towards this becoming an asset class and part of the institutional portfolios. Now, how quickly that evolves, that's still an open question, but it is becoming part of the strategy of institutional investors' portfolios.
Just to add on to that thought, Denis, one of the reasons why I think crypto has suffered so much this year actually is that all of a sudden it was playing in the same investment pool as traditional assets. And we saw this a little bit in 2021, where when we, especially looking at retail flows, if you look at the new net cash that went into kind of traditional exchange traded funds or mutual funds in the US in both equities and bonds, various stages in 2021, when we were riding this massive liquidity wave kind of post-pandemic, the inflows into Bitcoin, as captured by the change in realized market cap from week to week, the inflows into Bitcoin were as big as the flows into traditional asset markets from retail investors. So actually what it looked like was that Bitcoin was it was playing in the same pool. And then of course, then the only danger of that is that then what subsequently happened in 22 this year was that that pool got drained as the Fed tightened policy, and Bitcoin, because it's a more volatile asset, has fallen further. But it rode the wave of liquidity in 21. It's now crashed with everything else in 22. But I think, Denis, to your point, it means that crypto and digital assets are in the same pool as traditional assets, as viewed by the size of retail investor inflows and now unfortunately outflows. So there's an element of acceptance here, I suppose, is what I'm kind of getting to.
Agreed.
Denis, Michael, thank you very much.
Pleasure.
Thank you.
And thank you for listening. To find out more about the issues discussed in this podcast and to read our latest digital digest, please visit statestreet.com.